In this video, we are going to talk about dividend stock for high growth. So before starting this video, please like this video, and subscribe to our channel for the future updates. Last year's unprecedented pandemic threw financial markets for a loop, at least for a few months. Although the bear market of 2020 was the shortest in history, it lasted long enough to damage income investors by reducing or suspending dividend payments. This same setting, on the other hand, served as a testbed for dividend growth stocks. Throughout the pandemic, companies that were able to not only sustain payouts but also announce dividend raises showed a high degree of fiscal soundness, which bodes well now that the world is beginning to return to normal. Dividend growth stocks, in general, provide a range of advantages to investors. Dividend farmers, unlike bonds with a fixed principal and interest payment, will have a higher baseline of income year after year. The money can be used to buy more stocks, open new positions, or simply be saved and spent. Here's a list of the dividend stock for high growth. Let's start. Number 10. Lowe's. On this list of dividend growth stocks, home improvement retailer Lowe's, low, $196.25, has the highest rate of payout improvement. It has increased its quarterly dividend by 16.5% a year, which means the dividend will double every 5 years or so. At 1.2%, new investment won't get much of a return. However, sustained dividend growth could boost that yield over time, and given that Lowe's pays out just 31% of its earnings in dividends, the stock has a lot of upside there. Lowe's company seems to be in good shape right now. Pandemic developments have boosted the housing market, with a greater focus on remote workers improving their surroundings, resulting in increased home improvement spending. "We own Lowe's, it's our number one possession," O'Hara says. It has the highest dollar-free cash flow, so it carries the most weight. Traditionally, investors have gone to Home Depot for the dividend, but Lowe's is catching up, Brian says, adding that both stocks seem to be very high-quality brands. Number 9. Illinois Tool Works. Illinois Tool Works, ITW, $230.46. Which provides engineered goods and machinery to a variety of industries around the world, may not be a household name, but it's one of the most well-known businesses among people who create or fix things for a living. ITW will profit from individual trends as they ebb and flow thanks to its diverse product line. Metal fasteners and plastic components in the company's automotive business, for example, will benefit from any development in that sector. Its construction division supplies critical materials for housing construction, which has been an especially hot market in recent years. Gradient Investments' Jeremy Bryan says, "It's a fruitful field as long as you realize it might be more cyclical. Most corporations are cautious when it comes to dividends, but markets are cyclical." In terms of earnings and sales, Illinois Tool Works made it through 2020 with a modest showing. Despite mediocre earnings and sales growth, ITW managed to maintain a healthy 16.7% profit margin last year as the industry leader. The 5-year compounded dividend growth rate of the firm is approximately 16%. ITW, on the other hand, pays out more than 2/3 of its income in dividends, so maintaining that pace would require strong earnings growth. Number 8. Hormel Foods. Hormel, HRL, $46.20, best known for making Spam, but also for its namesake meats and chili, Dinty Moore stews, and Skippy peanut butter, did well during the pandemic, but has since leveled off, with shares roughly flat over the past 52 weeks. Revenues increased by just 1.2% in fiscal 2020, which ended in October, but were still a record $9.6 billion. However, net earnings fell by 7.2%. However, the consumer staples mainstay was able to increase its dividend from 94 cents to 98 cents per share. The payout has increased by an average of 12.3% a year over the last 5 years. With a payout ratio of 60.4%, the company has space to raise its dividend over time, though stronger bottom-line performance will definitely increase its potential to be more generous. Number 7. Automatic Data Processing. Automatic Data Processing, ADP, $186.99, is a well-known payroll processor that also offers other HR services. It's also a top large-cap dividend growth stock, with annual dividend increases of nearly 12% on average over the last half-decade. The company's fiscal 2020 year, which ended in June, was a year of moderate growth. Compared to a 22% rise in net earnings and a 6% increase in revenue in fiscal 2019, net earnings grew by around 8% and revenue increased by 3%. The company's ability to give its customers as many payrolls and other services was likely affected by the company's wild swings in job rates. Nonetheless, in March of this year, the stock reached its pre-pandemic peak and has since exceeded it. Number 6. Air Products and Chemicals. Air Products and Chemicals, APD, $288.48, is an excellent example of a mature business with slower growth prospects that can nevertheless increase its margins and pass those gains on to shareholders. While only seeing single-digit earnings growth in 2020, the organization was able to boost its bottom line through the worst economic downturn since the Great Depression. Despite operating in the high-cost environment of industrial production, the organization was able to achieve a profit margin of 21%. Customers come from a wide range of sectors, according to the industrial gas supplier. This diversification ensures long-term stability. At the moment, the only complaint on APD is a high forward P/E of 32. However, the company's overall trajectory makes it a compelling story for investors looking for high-quality dividend growth stocks. Number 5. Franklin Resources. Financial stocks may be a source of dividend growth, but they do face some industry-specific challenges. For example, the Federal Reserve is scrutinizing several larger banks' dividend and buyback spending. It's much more difficult to assess their willingness to pay dividends consistently. Financials are now enticing, Brian says as a counterpoint. They didn't slash their dividends, and they faced increased regulation since 2008-2009, but they're still in the best shape they've ever been, and their yields are likely to rise over time as interest rates stay low. One choice is to break the difference and concentrate on non-bank financials with a clear dividend growth track record. Franklin Resources, Ben, $30, appears to meet the criteria, with a cumulative dividend growth rate of 9.2% over the last 5 years. Franklin Resources is an asset management firm that is best known for its work with Franklin Templeton Investments. It currently manages $1.5 trillion in assets and employs 1,300 investment professionals all over the world. Number 4. Cisco. Cisco, SYY, $84.73, a restaurant supply company. Sounds like the kind of company that was hit hard by the pandemic, and it was. It is, in reality, still the case. During the 2020 decline, shares fell by as much as 65%, and they are only just a few percent below pre-pandemic peaks. In our opinion, SYY is very well placed to profit from the restaurant recovery, says CFRA analyst Arun Sundaram, who rates the stock as buy. SYY has been investing in its customers, staff, working capital, and technology in preparation for a rebound later this spring and summer once more people have been completely vaccinated, says the company. SYY, like many of the dividend growth stocks on this list, has a low dividend yield, 2.1%, but a high compounded growth rate, which implies better returns on cost for long-term investors. In fact, Cisco has increased its payout by 7.7% annually over the last 5 years. Number 3. McDonald's. While the restaurant industry shut down last year, fast food chains were able to remain open thanks to established drive-thrus and improved delivery options. There's nothing wrong with McDonald's, says O'Hara, but they're currently having trouble with the other side of the COVID trade. Despite being open, fast food traffic is down, likely because more people are cooking at home. McDonald's revenue fell 9% last year, and profits fell 24%. Nonetheless, according to S&P Global Market Intelligence, Wall Street is bullish on McD's future prospects, with 21 strong buy ratings and another 7 buys, compared to just 9 holds and no sell ratings of any sort. Number 2. Clorox. Clorox, CLX, $182.50, was a well-known brand and a good seller at the start of the pandemic, with its germ and virus-killing goods flying off the shelves. However, shares have lost nearly a quarter of their value since August, dropping them back to pre-pandemic levels. Although Clorox is well known for its virus-killing bleach, the company's vast line of household products includes Pine Sol, Liquid Plumber, and the Greenworks brand, as well as food products under the Hidden Valley name, vitamins, minerals, and supplements. Its other consumer brands include Kingsford Charcoal, Glad Wraps, and Fresh. Number 1. Erie Indemnity. Erie Indemnity, Erie, $214.02, is a dividend growth stock that provides insurance distribution, underwriting, and policy issuance in 12 states and Washington, D.C. It has a market cap of approximately $12 billion, so it's theoretically a large-cap business, but it's on the smaller end. Despite its scale, it's still a good investment for any income-oriented portfolio. As an insurance firm, it's the type of financial play that won't draw the attention of a major bank but can be extremely profitable over time. Even if a market is saturated, some of these insurance companies will post good earnings growth that allows them to aggressively buy back stock and increase dividends, says Jeremy Bryan, portfolio manager at Gradient Investments. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.